Here's what nobody's going to tell you about oil and gas investment. Now that we are well into 2025, every business owners I talk to seem to be planning their year-end tax moves. And every single year, I see the same trend. New clients show up with very common and disturbing pattern. They jump into oil and gas investment deals without understanding what they actually signed up for. In this video, I'm going to break down my personal experience as a tax professional and an investor in oil and gas. Well, so stick around because there's a lot to unpack. Look, I get it. You're sitting there with the tax bill and someone's pitching you on this oil investment and massive deductions that come with it. And suddenly you're thinking you found the magic bullet. The sales pitch sounds incredible. Write off 70 to 80% of your investment in year one. Passive investment for life sounds perfect, right? But here's what I want you to understand before you write that check. I'm talking about high net worth individuals putting serious money into oil and gas investment. And yes, there is a dangerous trend happening right now. Investors are throwing money into projects without proper due diligence, without really understanding what they are getting into. And the numbers are actually going to tell you a very scary story. The reality is a significant percentage of investors in oil and gas venues lose money, not break even, actually lose money, even when the well is producing oil. Here's what happens. Look, do not call us or click the link below if all you want to do is complain about your massive tax bill. Tax bill is the outcome of your actions throughout the year. It also reflects how your tax advisors are and how committed they are in helping you. Let's be clear, we don't have a magic wand. No one's got the magic wand. There is no special rule for the wealthy. They all follow the same tax code. And no, they don't cheat the system. They just know better and they are strategic about it. And they have people in their team that understands the tax code and they use the tax code to their advantage. Real tax strategies require specific actions, and those actions must be taken throughout the year, not just during the tax season. Your tax plan covers steps that have to be taken throughout the year, but the results are reflected over the years and year over year. The tax bill is just showing you how well you're stacking your finances, netting you a 6% or a 7% tax bill, or maybe not. April 15 is not no strategy. April 15 is just your report card. It's possible if you follow exactly what we recommend, it is possible for you to cut your tax bill in half, at least less than what you're paying currently. And if you are aggressive enough, you could potentially eliminate your tax bill for the future years. Click the link below to discuss this for free, but only if you're ready to take action and not complain. I have watched clients lose their entire investment in oil and gas well each year. Every single year, the money just disappears. And you know what's the worst part? Even the wells that hit oil, they don't always win. Because here's what they don't tell you in the sales pitch. Even if you get a well with oil, there are ongoing operational costs. And these are maintenance costs. These are regulatory costs. And it actually takes years, a lot longer than what you think. Typically 4 to 5 years for you to even just recover your principal. And that's if everything goes perfect. If the well keeps producing, if the oil price stays forever, and if operation cost does not spike. And here's another reality that is conveniently left out. An operational well, even a good producing well, still has to withstand the global challenges. We are competing with the worldwide commodity market, with every company on the planet competing for oil as a commodity. When Saudi Arabia decides to increase production, your well profit drops. When global demand shifts, your return shift. When Saudi Arabia decides to increase production, your well's profitability drops. When global demand for oil shift, your return shift also. When geopolitical tensions affect shipping routes, it affects your investment as well. You are not just betting on whether you will hit the oil or not. You are betting on global economies, international relations, and market forces completely outside of your control. We frequently discuss this with our existing clients. We talk about the importance of due diligence all the time. And all these years of doing this, I have yet to meet a client who actually hit a home run with oil and gas investment. Not one. Let that sink in for a second. 75 to 80% of people I work with have written off their entire investment. The entire amount was completely gone and they get no money back, zero, not a dime. Now, some do make it. Some of them see the returns. But even those clients who didn't lose anything, they wait for 4 or 5 years, sometimes longer, just to recover the principal they invested. Not to make money, just to get the money they invested, just to get it back to zero, just to recover what they put in. And during these 4 or 5 or 6 years of time that they have had their money tied up, they can't touch it. They can't reinvest it. They just have to wait and hope that the oil prices don't crash, and hope that the global demand stays strong, and hope that some international event doesn't tank the entire commodity market. The sales pitch usually highlights the tax advantages front and center. That's what they lead with. And first-time investors usually give it a go based on that alone. They're looking at a 6-figure tax bill and somehow telling them they can cut that in half with one investment, it sounds too good for them to pass up. And that's exactly how they get them. They prey on that year-end tax panic that business owners flee. Now, what I will not do here is sit here and give you names of companies or give you recommendations on who to work with. Why? Because it could be your investment next. And I would not want any one of you to lose out on any of your money on a dry well. I am not in the business of creating more casualty. What I am saying is spend more time in due diligence, way more time, and ask the obvious questions that most people skip because they are excited about the tax savings. Here are the 3 things that you absolutely need to know about investing in oil and gas. Number 1 is whether or not this oil well is single well investment or a pool of well. This is crucial. This is critical. More often than not, people lose money just because of this one point alone. You see, when you are joining a fund that only has one single drilling unit, the chances of losing all your capital are exponentially higher. Way higher than anyone wants to admit. Even on the exploratory wells, even on known territories where other wells are producing, I have personally seen wells dry up or produce oil that is commercially not viable for investors to keep them active. Why did this happen? Because there is an ongoing cost to keep well operational. We are talking about electricity to run the pump. We are talking about maintenance on the equipment. We're talking about monitoring and reporting requirements. And if the amount of oil and gas being produced isn't even justifiable to keep the well operational, forget about making money, it's better to plug and abandon the well at that point. Let me explain what plug and abandon actually means and what the rules are around it. When a well becomes uneconomical, meaning it costs more money to operate than it actually generates in revenue, the operator will plug a well and abandon it. And guess what? You as an investor don't get to say in the decision most of the time. That's buried in the operating agreement you probably did not read. Now, when you join a fund that has multiple wells in it, your chances of total failure are lower. Notice I said lower, not eliminated. It does not mean you are guaranteed a higher return or anything close to that. All it does is it minimizes your risk through diversification. This approach lets you potentially assume some of the tax benefit that the oil and gas investments can offer while keeping the risk more manageable. But let's be crystal clear here. The tax benefits are real. I am not disputing that. But the tax benefit don't really mean anything if you lose your entire principal investment. You might save $30,000 or $40,000 in taxes, but you lose out on your entire principal. That's not no win. That's a disaster, and you're still down $70,000 or $60,000 in actual cash. Read the full operating agreement. If you did not read and understand every single word of this entire operating agreement, please stop right here. Do not proceed. You need to get yourself familiar with every single word and every single provision of that operating agreement. You need to understand the exit strategy, or more likely the lack of one.